Welcome back. So in this video, we're going to start digging into what Profit First is. And I hope you enjoyed that little whiteboard video that you just watched. It kind of gives you a high level view of what Profit First is. But in this video, we're going to dig into that a little bit more. So we're actually going to talk about it in terms of how Profit First is a better bank balance accounting system than what's typically being used. So let's start out by asking the question of what Profit First is. So Profit First is based on a book that was written by Mike Michalowicz. And Mike Michalowicz is a business owner who's owned many businesses over the years, and he's had, unfortunately, several of those businesses that have failed. So after several of his businesses failed, he started looking into why businesses are failing and came up with the answer that we've talked about in previous videos, that the number one reason why businesses are failing are cash flow management. So he thought to himself, well, I need to come up with a system that's simple to use, that doesn't require them to do a lot of work, and that doesn't require them to be accounting professionals. So in came Profit First. So Profit First at its core is based on these three ideas. First, the idea is that you need to have your profit be your number one goal. And this seems like kind of a no-brainer because we all started our business for profit, right? We were looking for that freedom dream, and of course we need profit to get there. So we started our business for profit. But as we talked about in previous videos, your business starts going along, you start having all these expenses coming in, and all of a sudden profit becomes that leftover, and expenses become the main focus. Well, the point of this Profit First system is that we put Profit First back as that focus, and that then expenses become the leftovers. So in order to do that, we need to make sure that we put guardrails on our expenses, right? Because we can't have our expenses infringing on the money that we need to pay our profit. And same idea behind making sure that the tax money is saved, right? So we need to make sure that we have that money set aside so that, again, that isn't infringing on our profit money that we want to take. So Profit First is a bank balance accounting system. Bank balance accounting, at the simplest definition of it, is you looking at your bank balances to know how your business is doing and making cash decisions. So Profit First is a bank balance accounting system, but it's an improved version of bank balance accounting systems, different than what businesses are usually doing. So under the typical bank balance accounting system, this is usually how it works. It's usually just one bank account, pretty simple, right? So you've got one bank account and you're looking at that balance to decide whether or not you can pay for something and what you can do with the cash that you've got in your business. The problem is that the typical bank balance accounting system has a couple flaws in it. The first one is that it requires you to do mental math, which is rarely accurate. So say you are deciding on whether you can afford an expense. You're looking at your bank balance number, your one bank balance number, right? You're looking at it, and then you start doing this mental math in your head of, oh, I've got this coming out next week. I've got this check I cut last week, and then that should clear this week. And then you come up with this determination as to whether you can afford something. So let's say you decide you can afford this expense, and then you've miscalculated on something that comes out, and you're freaking out because now your account's overdrawn, right? So mental math is a flaw of the typical bank balance accounting system. Another flaw is that we tend to trust our gut, which often doesn't work. And I think the best way to look at this is, I like the example he gives in the book of, if you're a Star Trek fan, he talks about Spock. So Spock, of course, is the rational being, right? The one that makes all the decisions based on objective data, never goes with the emotional decision, right? Versus Captain Kirk. So Captain Kirk is, he's making rational decisions most of the time, but, every so often he's subject to that monkey brain flaw that we have, right? And makes those gut decisions based on emotion rather than, facts. So most of us are like Captain Kirk, which is a good thing, right? Because do we really want to live in a world full of Spocks? But so we're managing our business pretty well most of the time, but then every so often we make those gut decisions that maybe don't turn out so great. So another flaw of the bank balance accounting system done the typical way is that there never seems to be enough money left to pay yourself. We've talked about how profit ends up being that thing that's relegated to the leftover status, right? So if I have enough money left, I'll pay myself, and there never seems to be enough money left to pay ourselves. So in comes Profit First, which is a better bank balance accounting system than what is typically being used. So Profit First is based on 4 principles. It's based on the small plates principle, serve sequentially, remove temptation, and enforce a rhythm. So we're going to go into more detail on what those are. So let's look at what the small plates principle is. And this is the basis of Profit First, is that the idea is that we're going to take our money, and instead of having to look at this big lump amount, or maybe a small lump amount, we're going to divide that money into plates that all have different purpose. So at the basic level, Profit First has 5 bank accounts. So first bank account is income. Second is owner's comp. Third is profit. Fourth is taxes. And fifth is expenses. And they all have a particular purpose. So the income account is basically just our holding account. We hold the money there, and then we're going to move it around into the other banks. Our owner's comp account is going to be the money that we pay ourselves for the work that we do in the business. The profit account is going to be what we pay ourselves as a bonus, kind of like we own AT&T stock, right? And you get your quarterly dividends. Well, this is going to be our quarterly profit bonus dividend that we're going to get from that. The fourth bank account, our taxes, is where we're going to put the money to make it so that we have our tax money set aside when tax time comes along. And the fifth bank account is going to be the bank account where we put the money that we have available to pay our expenses. So what's going to happen is the money is going to flow in, your sales money is going to flow into, and we're going to put it in your income account. And then from there, we're going to move the money into all the other bank accounts, the profit, the owner's comp, the profit, the taxes, and the expenses bank account. So you might be asking at this point, well, how do we calculate those percentages? Because here we're going to move the money based on a percentage. So we're going to put a certain percentage in owner's comp, a certain percentage in profit, and a certain percentage in taxes, and a certain percentage in expenses. So the question is, how do we calculate those percentages? Well, I'm going to give you probably an answer you might not like, but there's 2 ways you can do it. First is you go buy the book and figure it out yourself, or you can take our course and we will help you figure it out. So the next principle that Profit First is based on is serving sequentially. So the money is going to be moving around from these accounts, but we're going to do it in a particular order. We're going to move the money first into our owner's comp and our profit accounts, because remember, we talked about how you're the #1 employee and you need to get paid first. So the money is going to go into those bank accounts first, and then we're going to move it to our tax account, and then we're going to move it to our expenses account. So the third principle that Profit First is based on is enforcing a rhythm. So we're not going to randomly move the money around. We're going to actually set up certain days of the month that we do this. And this can be based on, we'll determine what's best for your business and how many times a month that's best to do that. But we're going to pick those days and we're going to do it only on those days. And the benefit of this, we'll go into this a little bit more in a future video, but the benefit being that we've now established a pattern of when the money flows, and which makes it so it's easy to pay yourself, because there's the money's flowing on a certain time. It makes it easy to pay your expenses because you're only paying your expenses on certain days of the month, set days of the month, and the money's flowing around on certain days of the month. The last principle that Profit First is based on is the principle of removing temptation. So we're going to take these 2 accounts, the profit and the tax account, and we're going to actually put them at a different bank that's hard to get at. The idea being that the money in these accounts is sacred, and we want to make sure that it's not easy to get to, so that we get tempted to spend it on expenses. So by moving it to another bank, it's going to make it so that we don't get tempted to borrow from it. So let's run through an example to look at how the Profit First system works versus the typical bank balance accounting system. So we're going to play a game called Can Your Business Afford It? And the expense that we're going to look at, whether or not the business can afford, is a conference fee of $2,000. So I picked this one because I'm a conference junkie and I love going to conferences. I love thinking about what I'm going to learn at them, and I'm really, really good at justifying whether I can afford them or not. So question is can we afford a $2,000 expense? So under the typical bank balance accounting system, you would log into your bank account, and you would see that you've got $10,000 in your checking account. So $10,000 in the bank account, $2,000 expense. So we're deciding whether we can afford that or not. So you might go through the whole process of the mental math, right? And I've got this coming out, blah, blah, blah. You might go through the whole gut decision thing where, oh, I'm going to pay this $2,000 on this conference, and I'm going to make $20,000 off of it. I'm going to get a 10 times return off of this. And then you might be thinking, well, I know that some of this $10,000, I really did want to do something with it, but you know what? I won't have any money left over after the conference fee, so I'll pay myself later. So you're going through all these things that happen in the typical bank balance accounting system, right? And the idea, the question of, can your business afford it? I don't know, probably. There's a good chance you might say yes. Yes, my business can afford this. So let's look at the thought process and the decision-making process under the Profit First bank balance system. So we've divided our money up into these different buckets. And so we've got this much money and the accounts here. But in reality, we really only need to look at this one account right here, right? The expenses account, to decide whether we can afford this expense or not. Because we've already put our money into all the other plates that we need it to be for the purpose that those are intended for. So decision making under the Profit First bank balance system. So we log into our bank account and we see these three accounts. Because remember, we've moved our profit and our taxes account to a different bank. So we're not seeing those balances when we're logging into our bank account. So $2,000 conference fee, I mean, really, we should just be looking at our expenses bank account, right? So we've got only $1,500 in there. So, I mean, can your business afford it? Is probably a pretty easy decision. No, it can't afford it. You might go through another step though, and we're going to talk about this when you get into the course, the whole idea of what's my return on expense going to be. There's a chance that if you really, really do think that you're going to get a $20,000 return off of this $2,000, you might decide that it's worth it to take it out of your profit account. But the main point here is that we've just added something into your decision-making profit. What we've added into it is a couple different things. We've created a different process to begin with to making the decision, right? Because now you've got to have this this thought process of weighing that expense. I don't have enough in my expenses account, so now I've got to look at whether I'm going to take money out of my owner's comp account or my profit account. So you can very easily, under the Profit First system, you can easily see the trade-off between paying this expense. How is that going to affect my owner's comp and my profit? Because if I pay this, I'm going to have to take money out of those. So it really does truly put your profit first and top of mind. And I speak from personal experience that once the money goes into your profit account or your owner's comp account, it is very, very difficult to take it out of there. So you've got to really, really be able to justify in your mind that you need that expense at the expense of taking that money out of your profit and your owner's comp account. So we're back to this whole profit first in a nutshell, right? Pay your profit first, put your profit first. And in order to do that, we're going to put guardrails on our expenses, and we're going to make sure our tax money is saved so that those expenses and taxes are not infringing upon our profit money that we are going to get paid first, remember? So in the next video, we're actually going to go into more detail on how those four principles, the smaller plates, the serve sequentially, the enforce the rhythm, and the remove temptation, we're going to go more into the psychological behaviors behind those and why profit first, and how it works with those behaviors rather than trying to get us to change them.